You've read the books, maybe 2, maybe 5. You understand compound interest. You know what an index fund is. You've watched enough finance content to explain the difference between a Roth and a traditional IRA to someone who's never heard of either. And your savings account still has the same number in it that it had 6 months ago. That's not a knowledge problem. You already know enough to change your financial trajectory. Most people reading about personal finance do. The problem is the gap between what you understand about money and what you actually do with it every single day. And that gap is not closed by consuming more content, understanding more concepts, or finally finding the framework that makes everything click. It's closed by 10 habits so small they barely register as decisions, which is exactly why they work when everything else doesn't. Here's what's actually happening. You watch a video about automating savings and think, I should do that. You read about net worth tracking and think, that makes sense. You learn about negotiating bills and think, I'll try that sometime. And then sometime becomes a week, a month, 6 months of knowing exactly what to do and not quite doing it. That's not a character flaw. That's what happens when knowledge doesn't have a behavioral trigger attached to it. Information sits inert until something converts it into action, and that something is almost never motivation, discipline, or the right mindset. It's a tiny, repeatable habit that makes the action easier than the inaction. My name's William, and today we're going through all 10.
The gap nobody talks about. Most financial content operates on the assumption that the problem is knowledge, that if people just understood compound interest clearly enough or finally grasped what an index fund actually is, the behavior would follow automatically. It doesn't. The research is consistent on this. Financial literacy scores have essentially no predictive relationship with financial behavior when measured in isolation. People who can accurately explain how a 401k match works still don't capture it. People who understand credit card interest still carry balances. Knowledge without a behavioral trigger attached to it sits inert, consumed, understood, and never converted into action. The 10 habits in this video are not new information. They are behavioral triggers, small, repeatable, mostly automatable actions that convert what you already know into what you consistently do. The size is intentional. Tiny habits survive contact with real life. Grand financial overhauls typically don't make it past the first complicated week. Habit 1. Calculate your true hourly rate once and keep it somewhere visible. Your salary divided by your working hours is not your hourly rate. Your salary divided by all the hours your job actually consumes, commuting, decompressing, preparing, recovering, is closer to the truth. Someone earning $60,000 a year who works 45 hours a week, commutes 90 minutes daily, and spends Sunday evenings mentally re-entering work is not earning $28 an hour. They're earning closer to $17 when the full-time cost is counted. That number changes every purchase decision it touches. A $340 impulse purchase isn't $340. It's 20 hours of your actual life. Some purchases survive that reframe, many don't. The habit is calculating this number once, writing it somewhere you'll see it, and letting it run quietly in the background of every discretionary spending decision you make. This takes 15 minutes to do once. The behavioral return runs indefinitely.
Habit 2. Automate savings before your paycheck becomes visible. The research on savings behavior is unambiguous. The single most reliable predictor of consistent saving is whether it happens automatically before the money enters the spendable account. Not discipline, not motivation. Automation. The habit is simple. Set up a standing transfer from your checking account to a high-yield savings account or investment account timed to coincide with your pay date, before you see the balance, before the week's expenses have claimed mental ownership of the income. Even $75 automated on payday produces more consistent long-term results than $300 saved manually when there's money left over, because there is rarely money left over when saving is the last step in the sequence. High-yield savings accounts currently pay 4.0 to 4.2% annually. The national bank average is 0.39%. The automation habit and the account choice together take 20 minutes to set up. Most people never do either. Habit 3. Schedule a monthly money check-in. 8 minutes, same day, every month.
Not a full budget review, not a spreadsheet audit. 8 minutes on the first of every month looking at 3 numbers: what came in, what went out, and what the net worth number did. The behavioral purpose of this habit is visibility. Financial decisions made in the absence of regular visibility default to optimism, the assumption that things are roughly fine because nothing has catastrophically failed yet. Regular visibility replaces optimism with accuracy, and accuracy, even when uncomfortable, produces better decisions than comfortable vagueness. The first check-in is the hardest because the numbers might be worse than the mental estimate. Every subsequent one is easier because the baseline is established and the trend is the point. 1 month of data is noise. 12 months of data is a pattern you can actually work with. Habit 4. Run every significant purchase through an asset versus liability filter. An asset puts money into your pocket over time. A liability takes money out. The habit is asking one question before any purchase above a threshold you define. $100, $200, whatever fits your situation. Is this moving money toward me or away from me over the next 3 years? Most purchases are liabilities. That's not a moral judgment, it's a mechanical one. The car, the furniture, the subscription, the upgrade, they cost money to own and decline in value while doing so. The question isn't whether to buy liabilities, it's whether you're buying them consciously or automatically. The filter doesn't eliminate discretionary spending, it converts it from a default into a decision. And decisions, even when they reach the same conclusion as the default would have, produce different financial behavior over time because they carry a different level of awareness into the outcome. Habit 5. Track your net worth quarterly, 4 times a year, 10 minutes each. Assets minus liabilities. Everything you own minus everything you owe. Updated 4 times a year in a spreadsheet, a notes app, or a piece of paper kept somewhere you'll find it. The habit works because net worth is the only financial metric that tells you whether you're actually building anything, as opposed to whether you're currently managing the month. Income tells you what's coming in. Spending tells you what's going out. Net worth tells you what's accumulating, and accumulation is the only version of financial progress that actually matters long-term. Quarterly tracking also creates a relationship with the number that monthly tracking makes too granular and annual tracking makes too abstract. 4 data points a year is enough to identify a trend, respond to a problem, and feel the compounding start to become visible in a way that sustains the behavior. Habit 6. Negotiate 1 bill every quarter. 1 call, 15 minutes. Cable, internet, insurance, phone, streaming bundle, gym membership, 1 bill per quarter. Call the provider, reference a competitor rate, ask what retention offers are available. A 2023 Consumer Reports study found that 70% of people who called to negotiate a bill successfully reduced it. The average reduction was $34 per month. 1 call, 15 minutes, $408 annually, redirected automatically into savings because the bill reduction hits the account and the automation captures it before lifestyle absorbs it. 4 calls a year, 4 bills renegotiated, compounded savings redirected into investments. The habit requires no financial expertise, no confrontation, and no outcome guarantee. Just a 15-minute call most people never make because it doesn't feel significant enough to prioritize. Habit 7. Invest in 1 skill per quarter that directly increases your earnings ceiling. A single skill acquisition that adds $5,000 to your annual salary anchors every future raise, every future negotiation, and every future role from a higher starting point. The compounding is not metaphorical, it is arithmetic. The habit is allocating a fixed amount, $50, $100, $200, whatever the budget supports, to 1 targeted skill per quarter. Not general self-improvement, specifically skills with documented premium compensation attached to them in your industry or an adjacent one. Technical skills with durable demand, communication skills with broad professional application, negotiation, which research from Carnegie Mellon identifies as worth approximately $1 million in lifetime earnings when systematically applied across a career. The return on skill investment made early is not linear. It anchors the baseline from which everything else grows, and that baseline compounds for every year of the career that follows the investment. Habit 8. Start investing before you feel ready, with whatever amount won't paralyze you. The average age at which Americans open their first investment account is 33. The cost of that delay, relative to starting at 23, is approximately $250,000 in foregone growth at historical market returns on a modest monthly contribution. The habit is opening the account before the amount feels significant. $30 a month in a Roth IRA is not a meaningful investment. It is a meaningful habit, one that exists, runs automatically, and scales with income increases rather than requiring a fresh decision each time circumstances improve. The people who wait until they have enough to invest seriously tend to wait much longer than they intend. The account that exists with $30 in it will receive the next raise. The account that doesn't exist yet will receive the next excuse. Habit 9. Have one honest money conversation per month. With a partner, a friend, a family member, a colleague you trust. One conversation that involves actual numbers rather than vague references to doing okay or trying to save more. Financial behavior is socially regulated to a degree most people significantly underestimate. The spending patterns of your immediate social environment are the single strongest predictor of your own spending patterns, stronger than income, stronger than financial knowledge, stronger than stated intentions. The person whose social circle normalizes investment conversations, salary transparency, and honest discussion of financial mistakes makes measurably different decisions than the person whose social circle treats money as an uncomfortable private subject. One honest conversation per month doesn't require confessing your balance sheet to acquaintances. It requires finding one person with whom the real conversation is possible and having it regularly enough that financial honesty becomes a normalized behavior rather than an occasional uncomfortable exception.
Habit 10. Acknowledge one financial win per month, however small. The behavioral research on habit formation consistently identifies positive reinforcement as the mechanism that converts a behavior from effortful to automatic. Financial progress is particularly resistant to positive reinforcement because the milestones are distant, the feedback is slow, and the day-to-day experience of good financial behavior feels indistinguishable from the day-to-day experience of bad financial behavior until years have passed. The habit is deliberately identifying one thing per month that went right: a bill paid ahead of schedule, a savings target hit, an impulse purchase declined, a negotiation that worked, and acknowledging it specifically rather than moving immediately to the next thing that needs fixing. Progress that gets acknowledged gets repeated. Progress that gets immediately superseded by the next problem gets abandoned. Here's what all 10 habits share. None of them require more knowledge than you already have. Every single one converts existing understanding into repeatable action, which is the only version of financial literacy that actually changes anything. The person who reads every personal finance book and does nothing with it is not financially literate. The person who automates $75, tracks their net worth quarterly, negotiates one bill every 3 months, and has one honest money conversation a month is, regardless of what they've read. Financial literacy in 2026 is not what you know about money, it's what you consistently do with it. Pick one habit from this list, not all 10. 1. Do it this week, then add another. The compounding works on habits the same way it works on money, slowly, invisibly, and then suddenly, in a way that makes the starting point feel impossibly far away.